Hello, Marc from ADM Investor Services International, with some thoughts on the US Treasury curve move and its impact on other markets, and indeed what evidence there is that this is prompting any volatility, if at all. So my first chart this week is the US 10-year yield spread. As one can see, it's jumped sharply higher, though I think the notable aspect of this really, and it's a notable aspect of quite a few of these charts, is we're not talking about something which breaks a trend in the same way that we saw trends broken very sharply back in March or April last year, but something which is an extension of a trend, even if it is something which goes against the expectations that the rates will remain lower for longer, and therefore Treasury yields will remain contained in a well-defined range, which we've seen already in the latter half of last year. That's clearly not the case. My second chart is the US German 10-year yield spread. And I mention this one simply because this is always important in terms of currency direction, above all for dollar euro. It doesn't always trade in line with it, but nevertheless what one can see is, as much as it's been higher, we are definitely trending in a direction which is far more favorable for the US dollar, which brings me to my third chart, which is the US dollar index. Now this puts that recovery that we've seen in the dollar versus the euro into some perspective. It's clearly a very, very modest one. It doesn't mean by any manner of means that the dollar is out of the woods yet, but it is a reminder that interest rates differentials do matter. And this is important because if we do get the sort of stimulus that people are talking about from the new Biden government, then there will be further upward pressure on yields and expectations of a stronger recovery there, while the hampered process of vaccination distribution in Europe will leave people wondering whether we are going to get the recovery as soon as people had been hoping in Europe. So how has this played out in terms of volatility indices? I think that's an important point. My first chart on that front is the Bank of America Merrill Lynch Move Treasury Volatility Index. And I think the remarkable thing is, as much as we've seen some quite sharp moves up in yields and steeper in curve terms in the US, both at the front and in the longer end, what we're also not seeing is a big move higher in volatility, certainly not in the same sort of way that we had in volatility shocks last year. And that brings me to my fifth chart, which is the VIX Volatility Index. And as one can see there, the trend remains the same. People on any spike in volatility continue to believe that the best thing to do is sell volatility. There is a good deal of complacency. There's a good deal of lack of reaction to anything which is negative, be that market news, economic news, or indeed political news, as we've seen. So this brings me to my final chart in respect of the dollar, and that is, so what has this upward move in terms of the dollar had on commodity prices? I've compared the Goldman Sachs commodity price index to the WTI oil second month future to try and iron out some of those spikes from last year.
4 minutes
down. And as one can see, what we're getting is a move which is no longer actually being led by anything to do with the weaker dollar, but the move higher in oil. Move higher in oil is perhaps one trend which we need to keep a close eye on, because it could feed into more inflation, which would mean perhaps a reassessment of central bank rates at some stage. And those are the thoughts for this week.